Good afternoon, everyone, and welcome to Prestige Wealth Management Group's first quarter 2023 economic and financial markets update. On today's webcast, you're going to hear from Prestige Wealth Management's CEO, Roy Williams, Wealth Advisor John D'Angelo, and Prestige Wealth Management Senior Portfolio Advisor Paul Esposito. Just a little housekeeping. We are not able to take any live questions during today's webcast, but if you do have a question, please send your question to pwm@prestigewmg.com, and we'll be sure to answer it. With that, I'm going to pass it over to Paul Esposito to get things started.
Okay, Michael, thank you very much. So here's just a quick overview of the agenda. So we do want to get into the crux of, the state of the state for the U.S. economy, obviously inflation, and, the Fed's, ongoing battle with it. And then review equity fixed income valuations. And then we've got a nice little chart that, from a contrarian standpoint, shows us why maybe not reacting to some of the, very drastic near-term news is the best way to stay invested over the long run. But before we get into, recap of the economic data for the quarter, we sort of wanted to put to rest a lot of the concerns that clients have had about just the overall state of the U.S. banking sector. I mean, the bank runs that we saw with Silicon Valley Bank, most notably, and then, of course, Signature Bank following, and then, ultimately First Republic almost on the ropes before being properly rescued. Has created a lot of concern that, is this a symptom of, a greater problem in our, the financial stability of our banking system? And, if you really dissect the issue at hand, I mean, this was really, the crux of the problem was induced by the Fed's very hawkish action. So the Fed raised rates in a period of 10 months, 450 basis points, well, call it 475 basis points. And that essentially put banks and their deposits, for certain banks, should I say, at, a mismatch. When banks create deposits, they usually, the whole notion of fractional reserve banking is that you're only going to keep maybe 10%, of the total amount of deposits on hand in order to handle withdrawals at any given time. So when, your loan portfolios are consisted of treasuries that are maybe longer dated or mortgage-backed securities, when the Fed raises rates to that extent, that actually puts pressure on that portfolio and actually causes it to lose value. And in turn, banks are now, we can thank the 2008-2009 financial crisis. According to Dodd-Frank, they're required to mark to market their portfolios. So what ends up happening is this, for banks that are not well capitalized and don't have as well dispersed of a deposit base, it could put them into, a very compromising position. So if we look at the banking sector as a whole, the capitalization, the tier 1, tier 2 capitalization ratios that the major banks adhere to, right, due to regulatory requirements, very robust. And if you look at their deposit base, they have a very large percentage of their deposits for single depositors below the FDIC limit. So take, for example, Wells Fargo or JP Morgan, they've got, in excess of $1 trillion+ of deposits, but that's dispersed out over, probably 20,000 branches. Whereas if you look at really what led to Signature Bank and Silicon Valley Bank's demise, well, let's just take, for example, Silicon Valley Bank. They had $250 billion in total deposits. You only had 2.7% of those that were below the FDIC limit. So, in essence, 97% of their deposits were uninsured. And their depositor base was, I think, something like 5 or 6 banks. And it was a lot of private equity money. So when they had a run, it was actually very swift, and it was very difficult for them, and most notably due to the mismanagement of their loan portfolios. They had loans that had maturities that did not match their deposit liabilities. So when we look at what led to these events, you could argue that yes, part of this was induced by the Fed, and to kind of slap the Fed's hands a little bit further, the Fed, before they embarked on their rate hike cycle, they were only stress tested for 250 basis points. They didn't stress test for the full 450. So when cracks like this manifest, it's important that they get on top of it, which they did. The Fed, along with the Treasury, very swiftly, created their bank term funding program, and with it, in essence, for the time being, FDIC limits are unlimited at this point. So it really helps stave off, any further cracks in the system. So just to reiterate, the banking sector, if you look at, as a whole, is still very sound. And I would say the areas that, had concern were really your very, very small regional banks and, very undercapitalized credit unions. But the majors have certainly are very sound. And a lot of this, you could look at the activity of deposits in March, and it's really there's a dichotomy out there. So banking sector as a whole really hasn't lost deposits to the amount that people would think investors are hoarding cash or burying cash in their backyard because they don't trust banks. It's really just a function of size and FDIC insurance. So going into February, if you look at the solid white line, that represents the net asset exposure of small commercial banks. And that was sitting, almost at, $710 billion net. It dropped, almost $150 billion within the period of weeks leading up to the bank run on Silicon Valley and then ultimately Credit Suisse. But look at the blue line, which represents U.S. large commercial banks. That's almost every dollar that was lost was regained by those large commercial banks. And a lot of that is indicative, that the dichotomy of banking strength out there is indicative in a lot of the earnings. So last week you had the big four, I like to call them, JP Morgan, B of A, Wells Fargo, et cetera, that reported earnings. They had robust earnings, strong revenue growth in a very tumultuous quarter. And most importantly, their deposit base grew substantially. So, one bank's loss is another bank's gain. But again, on balance, if you look at the banking sector, so if we look at the S&P financial services sector, and we look at the subset, the banking subsector within that sector, it's dominated by large mega cap commercial banks. There are, maybe one or two sparse, smaller credit unions or regional banks in there. But again, they're all very, very well capitalized. So just wanted to put to rest, some of those concerns that investors have with regard to the banking system. Getting to the growth of the economy. So as of GDP reports tomorrow, and Bloomberg consensus estimates has, at least on an annualized basis, GDP growing at 2%. I find it interesting when you look at the consensus from where we start at the beginning of the year, should I say, toward the end of last year into present. Again, a lot of the growth concerns that hung over the economy last year spilled over into this year. Of course, the banking crisis, that ensued in March contributed to some of those growth concerns. And of course, the Fed's policy on raising rates also, contributed to growth concerns. But I find it very interesting that, if you look at the range at the beginning of the year, we were at, on the low end, -2%, annualized growth, the high end at 1%. And that just slowly rose, even, through the bulk of, the turmoil that ensued in March. The Fed's GDP now estimate, which I've got to give them credit, has gotten a lot more accurate over the years. They've ratcheted down, probably, again, because of, some of the concerns over credit becoming a little bit more restrictive with banks toward the end of the quarter. So they've ratcheted down to about 2.5%. Is their estimate for the quarter. Now, part of that is also due to a decline in U.S. residential investment growth. Naturally, we've seen a higher rate environment. Home builders have slowed down. New home starts have slowed down as well. So a lot of that CapEx and a lot of the consumption related to those investments has slowed down most notably. That's contracted about 5% for the quarter. So again, that's where the concerns were for a lower growth in overall GDP. For the year, we're still pegging the estimate of growth at about 1.2%. Again, still positive, but you could argue that the growth concerns that we're experiencing in the first half, and John will touch on earnings a little bit later on, and how that relates to GDP. Still, all in all, not a bad number. Again, given the conditions that we're in. And with that, I'm just going to let Roy take over the rest of the econ. Dave.
Yeah, when we look at the unemployment picture, today Amazon announced that they're laying off people in HR and also in the cloud. And you've seen a bunch of announcements in technology. You have to understand, since 2020, tech companies almost doubled their labor force. So I won't say they overhired, but most likely they overhired, and now we're adjusting. But as a percentage of the employment base, they're a very, very small percentage. We're seeing, just from a client perspective, clients' children and most clients still have their jobs and are doing well. To me, a telltale sign of unemployment is consultants being laid off. And we've had some calls with clients who are consultants, and they're still working. Obviously, J&J Consumer, they laid off people because, they're going public by year end. So again, they've shut down a division, which a client got laid off in. And also they've, got rid of all the consultants to try being lean and mean for the IPO. So unemployment at 3.5%, statistics, most economists will say if unemployment is below 5%, where 5% or below, we're at full employment. So, we may have unemployment increase to, 4.5% or a little more than that, and stay below 5% as we go through this. Unemployment historically does increase even if we're coming out of a recession. It's a lagging indicator. For example, in the financial crisis, unemployment continued to increase through October of 2009, even though the markets and the economy turned around in March. So, don't be surprised by that. And again, we still see the job market as very, very strong. Wage inflation, when we look at the hourly earnings trend, year over year has only been 0.6% from a year ago. So hopefully that gives the Fed some support for a rate pause. In terms of labor demand, which tends to be a leading indicator, the labor market has declined by 2 million jobs from last year. Also, although they remain high, and the labor market, I believe, is still very healthy as we go forward. But again, we may have some announcements. But when we have announcements, it's not as if in we look at the start of COVID or the financial crisis where tens of thousands of people are being laid off on a regular basis. That's not going to happen. This may be one of the first recessions where if we have a recession, a slight recession, we may have it with full employment and unemployment staying below 5%, which is interesting. Inflation, when we look at inflation, we're seeing, I don't know who shops at Costco. I shop at Costco. Most people, shop at Costco to some extent. We're seeing, prices drop there. Wood peaked at $1,400 and now is, been trading between $380 and $450. So we're seeing, a dramatic improvement in inflation, considering a year ago it was 9%, core inflation. And now we're running at a rate of 5%. Once we get to July, the year-over-year comparisons are very favorable. And, inflation will, continue to be under control. And, hopefully the fears will subside, which will cause the Fed, again, at this point, the Fed may increase rates one more time, but after that point, they should be done. In terms of OPEC, they recently cut their production, and you saw oil, spike to around $85, and now that it's been trading between 75 and 80, and we're seeing U.S. supplies increase. We do have a significant supply of oil, the U.S. by ourselves, so we can help it as long as it's not too much of a production decrease. But we see it at the pump. The pump prices are right now around $3.50. You think about it, a year ago we were paying almost $5 a gallon for gasoline. So it's significant, and gas drives a lot of the inflation numbers. So we'll see what happens.
Yeah, Roy, you bring up a really good point. And I just wanted to point out, to the audience that, if we look at the two trends, because we had discussed this earlier, if we look at headline number, right, which includes energy versus core, the headline numbers now cross below the core inflation rate on a year-over-year basis. And one of the interesting trends that, when we look at the Fed's projection, of inflation, their estimate for, getting closer to like 3% for the end of the year, we're certainly constructive because every time, and, we even pulled this chart and that relationship back decades, every time headline inflation dips below core in a noteworthy fashion, usually the trend of inflation is lower. And, that's indicative in energy prices. Recall 2020 where, we saw deflation, massive deflation in energy. And what happened? We were in a deflationary spiral. It wasn't until, beginning, first quarter of 21 where we saw oil prices recover drastically, as evidenced by the green line. And that inflation then fed into the services and the goods. We're starting to see some energy disinflation, which again should be very promising and constructive for the inflation picture going forward. I'm sorry, Roy, I just wanted to interject.
Next we're going to talk about home prices. It's really, when we look at the Schiller Index, you have about 5% drop. And again, it depends upon the area. Even New Jersey, it's regionalized about, where the supply is. The more supply, the larger the drop has been. Texas, which was a super hot market, has had a significant drop. Austin specifically, but yet Florida, most of Florida, because you have our tax season was very busy because we had a lot of clients move this year, and unfortunately, a bunch of them moved out of state. But Florida, the prices are holding up, even in the ravaged areas by the hurricane. Actually, prices increased, which is counterintuitive. When Sandy, a superstorm came through, prices at the shore went up; they didn't go down, which is counter to what people would think. But the low inventories are going to help the housing, even though we have interest rates above 6%. But again, it's regionalized depending upon where you're at and what the inventory is about in terms of how much the prices dropped. We don't see a huge drop in housing prices. We can correct another 5%, but again, low inventories is helping prices stay up, even though interest rates have gone up significantly. If interest rates stay up, I guess KB Homes or one of them had 60-some-odd% of the contracts cancel. Because you think about it, if you were buying a new home and you locked in or you thought you were going to have a 3% rate, and now rates are 6%, you could afford half the house you could afford before. So, we'll have to see how it plays out as we go through this, but low inventories is definitely going to help us during this time. The Fed and interest rates, it's interesting. When you look at, the Treasury market, the 1-year Treasury where it's at, and then you look at the 5-year Treasury, and, you're significantly less. So the Treasury market's telling us that the Fed, at some point, the end of this year, beginning of next year, most likely will start decreasing rates. As, when we look at what the inflation projections are and unemployment projections are, we'll have to see how it plays out. But, most likely as we go through 23 and into 25, you're going to see the Fed decreasing rates again, which will, to the last point, help housing and as we go forward, help the economy. Because we've been for a long time at a low interest rate environment, and a lot of people got used to those lower interest rates. And my advice is, if you're buying a house or kids are buying a house, maybe you look at a 3-year adjustable mortgage or something of that nature to make it more affordable right now for them until the Fed starts making a move on interest rates.
So, as far as valuations are concerned, when we look at the U.S. stock market, the picture is very similar, this quarter to last quarter. We were trading around fair value, probably the last few quarters, actually, and we're still in that same zone of fair value. And I think it's indicative of the mindset of some of these possible rolling recessions, where some companies and some sectors are doing better than others and exuding higher valuation metrics, while other sectors in the market have been hurt certainly by inflation and higher inflation over the course of the last year. So this decrease in inflation that we've had, and I would say also the projected numbers on inflation going through the rest of the year, should help some of these companies from an earnings perspective. We're in earnings season now. We're starting to see companies report, and I think one of the things that the market is really looking for is they're looking for some of these inflation-sensitive sectors, such as technology, such as consumer discretionary, and some of the communication services, for hints that maybe earnings, maybe the revenue declines are troughing, and maybe some of the forward views that they're going to come out with this quarter would tend to be maybe more positive, and then that would be a good thing for the markets. When we look at corporate earnings as a trend, they're expected to be positive, but maybe choppy for the first half of the year. And I think, I think that's our view, or been our view, is that the first half of the year might be market choppy, might be earnings choppy, but as the Fed gets toward the end of this rate hike cycle and starts to move toward what we think is going to be a pause in hikes for the second half of the year, that we may see a earnings growth start to return again. Once we kind of get through some of these inflation problems, we can look toward, big tech earnings, companies like Google, Microsoft. Microsoft reported last night better than expected numbers to possibly have or maybe drive earnings and drive stock prices in the second half of the year. So when we think about the forecasted range of the S&P, this is I think a really interesting chart, and it shows, even though it's kind of just the very right side of the chart, shows that since June of last year, when the markets bottomed at that, call it that 3,600 level, we've been trading in this range. We've been range bound, where the markets have been popping up toward 4,200 on the S&P, and we've revisited that 3,600 range, or even that 3,800 range a few times. And the markets have continued then to creep back up toward the top of the range. And I think that's in anticipation of either better inflation numbers or a more accommodative Fed statement. And I think once we get to that point, I think we'll see a more sustainable price recovery in the S&P. And our thought process is that we could see toward the second half of the year, the S&P 500, recover back up toward that, call it 4,500 mark, which would certainly indicate that we've finally, over the course of the last year or so, broken out of the range that we've been in. As far as the fixed income markets are concerned, we've seen an improvement there. I think fixed income returns are around 3% so far year to date. There's, I think, a bit of a tug of war when we think of it from short-term rates, and when we look at long-term rates. So we still have an inverted yield curve. Longer rates have started to fall, and I think that once again is in anticipation of a Fed pause somewhere this year. And Roy discussed earlier that we may see the Fed have to then pivot at some point and cut interest rates in order to support growth, and that's going to be positive for fixed income markets. We had I would say a really difficult 2022 from the standpoint of bond markets, because when bond yields go up, bond prices go down. Last year, with the Fed raising by as much as they have raised, it caused some mayhem, and especially in the longer term maturities. But now what we've started to see is some of those longer dated maturities yields start to soften a bit, and we've seen price recovery there. I guess you could say, as a side note, which is pretty interesting, we do have higher yields than we've seen in some time. So we're now getting paid a decent rate of return in the fixed income market as far as yields are concerned, and especially on the short end, I guess, of the curve right now, yields are been trading north of 5%. And when we look at the 2-year Treasury, yields still north of 4%, and that's not a bad return as an alternative. And we could also add cash yields are quite a bit higher than they've been for some time. So I'm going to turn it over. I'll turn it over to Roy, and he's going to discuss consumer confidence.
Consumer confidence. You got to be careful when you look at consumer confidence. The media. Especially when you look at the media is motivated. When have they said that it's sunny today and a beautiful day out? They don't. They use fear and just predominantly fear to drive the media sales. So, you got to be careful when looking at this. But the consumer confidence continues to improve which is excellent as we move through some of the challenges. And we again, as we went into the year, we didn't know about the banking crisis, but there was continued fears about inflation and higher rates. But again, when they're looking at it, it's backwards looking and not forward looking. So a lot of times when we look at consumer confidence, it's more of a forward looking indicator. So it's very positive that things are improving. But never ever, and this is a recommendation, make changes because you saw Kramer on TV, or actually Kramer, Barron's and some other people have done studies about his picks. They're not very good long term. So, he's an entertainer, and that's what he is. And a lot of the media has become more focused on entertainment rather than, facts. So, just be very careful in the information that you use and make sure you do some due diligence if you are using some information that you've obtained from the media sources. Do your own due diligence on, the information. So, this is an excellent indicator as, forward-looking. So, I think this is favorable. And, hopefully, we do have the debt ceiling coming up. That'll be a challenge. Hopefully, politics can be put aside and they can come up with some type of an agreement, which is it's in everybody's best interest to come up with an agreement. I remember 2011 when it became an issue and, it was solved and the markets, and that's why we don't recommend making a change. The markets dropped, precipitously 10, 15%, but 6 weeks later, they'd come back. So, getting out of the market is fine, but when do you get back in? It's impossible to know that point in time. So just be very careful. With that, I'm going to turn it over to Michael.
Yeah, we just want to thank everyone for joining us today. Something I don't think I mentioned at the beginning of the webcast today is we will be sending out a replay of today's webcast for you guys to view at your leisure. And again, just as a reminder, if you do have any questions, please send them in to us at pwm@prestigewmg.com, and we'll be sure to get back to you. Thank you guys very much for joining us.